An Arctic blast named Fern may seem to have passed, but it has stirred waves of macro trading on Wall Street. This extreme weather event represents a non-hedgeable tail risk for the U.S. economy. Bank of America Securities' latest research report states plainly that it could drag down U.S. first-quarter GDP growth by 0.5 to 1.5 percentage points. With current market expectations for Q1 GDP already at just 1.5% to 2%, a peak impact could push the economy perilously close to stagnation for the quarter. First, looking at hard, high-frequency data, the impact of this shock is already clearly evident. The BOFA team reviewed historical data from the 2021 Viola storm and ran model calculations. During the peak week of that storm, total U.S. credit card spending plunged by 370 basis points year over year, dropping from the previous 6-week average growth of 6% directly into contraction at 3.7%. More critically, this only captures the visible loss in electronic payments. Amid extreme cold, cash transactions, especially small payments in the service sector, fell even more sharply. Combined with inventory drawdowns due to supply chain disruptions, the actual drag on GDP from the 2021 storm was as high as 1.5 percentage points, far exceeding estimates based on card data alone. This Fern storm, however, differs entirely from the 2021 Viola in its focus and impact. Viola devastated the Texas energy corridor in the U.S. South, causing prolonged grid failures. While Fern has not triggered widespread blackouts, it has precisely hit the wealthier, more densely populated Northeast corridor. Bank of America's chief economist explicitly noted that the density of high-income households in the Northeast is much higher than in the affected Texas zone. Even with more resilient infrastructure, the marginal loss in per capita consumer spending is expected to be more pronounced, and the transmission effects on consumption will differ. This is the core reason behind BOFA's wide estimated drag range of 0.5% to 1.5%. The lower bound represents a baseline scenario, while the upper bound is an aggressive assumption accounting for compound shocks. However, there's no need to excessively worry about a fundamental reversal of the growth trend. BOFA also offers a clear, optimistic assessment. This shock is merely a classic temporary supply-side disruption, not a substantive contraction in demand. Historically, consumption spending suppressed by extreme weather tends to be released in subsequent quarters, creating a statistical catch-up effect. Simply put, the more Q1 GDP is suppressed, the greater the rebound potential in Q2. Full-year growth is highly likely to follow a V-shaped recovery rather than an L-shaped stagnation. The potential for Q2 GDP to exceed expectations would mirror the downside risks seen in Q1. Finally, let's discuss the core trading and policy implications. What investors should focus on most. For the Federal Reserve, a Q1 GDP miss would not trigger a reassessment of its policy path at all. This is merely base effect noise to be smoothed over, not a signal of a cyclical economic turn. The Fed will not alter its existing monetary policy stance because of this weather-related disruption. For us traders, the next 2 weeks require close watch on 2 key high-frequency indicators: the Red Book retail sales data and weekly initial jobless claims. If these indicators quickly revert to their normal trends, it would confirm the storm's impact was indeed short-lived. However, if credit card spending data persistently underperforms seasonally adjusted norms, then a reassessment of the true momentum of U.S. consumption would be warranted. After all, within the prevailing narrative of an economic soft landing, any such exogenous shock could become a catalyst for the market to reprice volatility. We must be alert to short-term swings, but there's no need to become overly bearish on the long-term trend.